All right, so welcome to the FX Trend Rider strategy. So this is a strategy that seeks to go long on currency pairs on a very strong uptrend. Once we've got a bullish candlestick pattern that's formed, at the same time, we're going to short currency pairs on a strong downtrend once a bearish candlestick pattern is formed. Now, this strategy works on all time frames, preferably 50-minute time frame and above. I personally like to trade this on the 15 minutes and the 1 hour time frame. Now, frequency of the trades, anywhere from 10 to 15 trades a month, or at times even more. Average win rate, we expect about 50 to 60% win rate. Risk to return ratio, you're always risking 1 hour to make at least 1.4 hour, 1.5 hour or more. And we trade this on all currency pairs. So if you're ready, let's begin this strategy. All right, so the first thing to do is to define a strong trend. Let's begin with a strong uptrend. So a currency pair is in a strong uptrend when the 6 EMA is above the 18 EMA, 18 EMA above the 50 EMA on the execution time frame. So again, it depends on which time frame you're trading on. For example, if you're trading on M15, then M15 will be the execution time frame, and you want to see that the moving averages are in sequence. Again, the 6 EMA, which is the red line over there, above the 18 EMA, the blue line, and that's above the 50 EMA. So 6 above 18, above 50, moving averages clearly sloping up. That's a clear uptrend on the execution time frame. In this case, we're trading on the dollar-franc pair. Now, at the same time, you want to ensure that on the higher time frame, you also have the same moving averages in sequence. The 6 EMA above the 18, 18 above the 50 on the higher time frame. So again, if you're trading on M15, higher time frame would be H1. There you go. H1 would be the higher time frame. If you're trading on H1, higher time frame would be H4. Trading on H4, higher time frame would be daily candles, right? You get the idea, right? So over here, we're going to see that dollar franc on both the M15 as well as the H1 time frame, on both time frames, you must see a clear uptrend. Again, the 6 EMA above the 18 EMA and the 18 above the 50 EMA. All right, so this must happen on both time frames. You're going to see that same pattern of moving average sloping up, smallest moving average to the biggest moving average. Now, at the same time, very importantly, you have to always ensure that the currency strength meter, known as the CSM, is aligned on the higher time frame. All right. So again, bear in mind, the CSM must be aligned on the higher time frame only, not on the execution time frame, only on the higher time frame. So in this case, the higher time frame is on H1. So on the CSM, we are looking at the H1 strength of the currencies, right? So again, you always want to be only buying the strong currencies and selling the weak currencies. So in this case, we are going long on dollar franc. So that means that we are buying the dollar and we are selling the franc. So the dollar has to be green and the franc has to be red on the higher time frame. So you can see on the higher time frame, sure enough, the dollar is green, which is above 60 points, and the franc is in red below 40 points, right? So when you have got all these elements together, you are in a very, very strong trend, and the probability is that this currency pair will continue moving up in the short term. Now, when you're going short on a currency pair, we want to see a strong downtrend. And again, how do we define a strong downtrend? Same thing. Number one, we want to ensure that on the execution time frame, example M15, if you're trading on M15, you want to see the moving averages again in sequence from the highest moving average down to the lowest moving average. So the 6 EMA below the 18 EMA, 18 EMA below the 50 EMA. So it has to look something like this. So over here, you can see that we're looking at the Aussie yen on the M15 time frame. All right, and you can see clearly moving averages are sloping down. We have got the 50 EMA above the 18 EMA and the 18 above the 6 EMA. Again, the 50 is the blue line, the thick blue line. The 18 is the thin blue line, and the 6 is the red line. Right, so right now we're only looking at 3 moving averages, the 50, the 18, and the 6. I know some of you are thinking, hey, what's this moving average over here, the one in brown, okay? Now that's the 12 EMA. We'll only be talking about that later under an alternative trade management strategy. But for now, just ignore that 12 EMA. Just look at the 50, 18, and the 6, all right? Now, at the same time, again, remember, when you're trading Forex, you never look at only one time frame. You must always look at the higher time frame to confirm your execution time frame. So again, on the higher time frame, in this case, higher time frame from M15 would be, that's right, H1, okay? On the higher time frame, same thing, the 6 EMA below the 18, 18 below the 50. So there we are. So on the H1 time frame, again, we want to see, again, the same sequence of moving averages sloping down. Again, the 50 blue line above the 18, above the 6 EMA. The third condition is always the currency strength meter, CSM. So again, always ensure the CSM is aligned on the higher time frame, not on the execution time frame, on the higher time frame only. So again, in this case, our higher time frame is H1, so we're only looking at the H1 currency strength. So in this case, we are going short on Aussie yen, which means we are selling the Australian dollar, right? And at the same time, we are buying the yen, okay? So remember, we always want to be selling the weak one, buying the strong one. So Aussie is weak red, so anything below 40 is red, and the yen has to be green above 60. So it always has to be aligned with the CSM, and with that we know it's a very strong downtrend. The probability is that prices will keep moving lower, giving us all the odds in our favor that the price will go in the direction that we want. All right, so once we have identified the trend, we have to wait for a candlestick pattern to trigger our entry. So let's look at the bullish candlestick pattern first, yeah? All right, so once we've got a clear uptrend, we want to go long, but we've got to wait for a bullish pin bar to appear. This is a signal that the price is reversing up again, all right? Or after a short-term retracement at times, yeah? So how do you define a bullish pin bar? It's a candlestick pattern that looks like this, this, or this, right? So all four qualify as a bullish pin bar. What do they all have in common? They all have a relatively small candle body, right? So you can see this, the candle body, and in this case, the candle body is just a straight line because the open and closing price is the same price, right? So they all have a small body, and next they have a little or no upper shadow or upper tail, but a long lower shadow or lower tail, right? So how long must the lower tail be? The length of the tail has to be at least 2/3 of the range of the candle, all right? So this qualifies as a bullish pin bar. Now, bear in mind that for a pin bar, the color of the body doesn't matter. So it could be a red or green or white body, it doesn't matter because the candle body is very small. What's important is the shade, long lower shadow, small or no upper shadow. So the moment you see that, boom, you can go long, all right? And I'll talk about, again, exactly where to put the buy order and the stop loss in a while. Just hold on to that. So again, if you look at this chart, can you identify where is the bullish pin bar? Which one? This one, there's the bullish pin bar over there. Okay, there you go, that's one. There you go, that's another bullish pin bar. Okay, so how about this one? Is this a bullish pin bar? No, it's not, because the body of the candle is too big. It's going to be a small, tiny body relative to the length of the candle. How about this one? Well, this one's a bit iffy, right? It's got a long shadow, but again, the body's a bit big, right? So this is kind of like a question mark, and I probably may not take this one. I want a small body and a lower shadow, right? So there you go. So you can see that it appears quite frequently. So the moment it appears, boom, it's a trigger to go long. Now, on the other hand, if it's a downtrend, we want to go short. So again, we're waiting for a trigger candle, and we're waiting for the opposite, called a bearish pin bar. So again, bearish pin bar is a candlestick pattern that looks like this, 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 or this. So you can qualify. Any of these are bearish pin bars. Again, what do they have in common? They all have a small candle body. Okay? There's little or no lower shadow in this case, but they've got a high, or they've got a long upper shadow that is at least 2/3 the range of the candle. So long shadow, long tail, and small or no lower tail, right? Again, the color of the body doesn't matter, can be red or green, doesn't matter. Just long upper tail, small lower tail, small body. That's a bearish pin bar. So over here you can see it's a downtrend, right? Where's the bearish pin bar that triggers our entry? There you go. That's your bearish pin bar. Ta-da! There you go, right? How about this one? Is this a bearish pin bar? This one. No, it's not. It's not a bearish pin bar. Why? Well, it's got a small body. Yep. It's got a long upper shadow. Yeah. But it's also got a long lower shadow. So that doesn't qualify. It's got to have a small lower shadow and long upper shadow, right? So this is not a pin bar. This is more like what we call a doji, right? Now, notice that this one over here, that's a bullish pin bar, right? But it's a bullish pin bar that appears on a downtrend. It's meaningless. Remember, the bullish pin bar has to appear on an uptrend to trigger a long. And the bearish pin bar has to appear on a downtrend to trigger a short. They have got to be matching. So this is the first type of candlestick pattern we use to trigger our entry, which is the pin bar. All right, so besides the pin bar, we also use an engulfing pattern as a trigger. So again, an engulfing pattern could be a bullish engulfing to trigger a long entry to buy the currency pair, or a bearish engulfing to trigger a short entry to sell the currency pair. So let's get the definitions clear. So first of all, an engulfing pattern always involves two candles, okay? The baby and the mother. Always got to be a baby and a mother, right? Okay, so for the bullish engulfing, the first candle is the baby candle. It must be a small bearish candle, relatively small bearish candle. And it's followed by a large bullish candle whose body engulfs the body of the bearish candle. Okay, so for bullish engulfing, it must always be a red candle followed by a green candle. Red bearish followed by green bullish candle. So it cannot be red, red, or green, green. It's to be red and green. Okay, and what you want to see is that the body of the bearish candle, right? So again, remember this is the opening price, that's the closing price. Okay, and for the bullish candle, that's the opening price and that's the closing price. And you want to see that the body of the bearish candle is within the body of the bullish candle. So again, think of it as this being the mother and this being the baby. And the baby's body has to be inside the mother's body, right? The mom's pregnant with the baby, right? Think of something like that, okay? So there you go, there's a bullish engulfing. Once we see that, we can trigger a long trade. So look at the chart over here. Where's the bullish engulfing pattern that you see? There you go. So that's your bullish engulfing pattern. There you go, right? So bearish candle, the body is engulfed by the bullish candle. Boom, there we go. That triggers our long entry. Okay, bearish engulfing, opposite, right? Baby, mother. But this time the baby candle is a small bullish candle and the mother candle is a large bearish candle. So bullish candle followed by bearish candle, okay? Again, for bullish candle, the opening price is over here, closing price over there, bearish candle openings over there, closings over there, right? And again, you want to see that the bullish candle body is inside the body of the bearish candle. So that's a engulfing pattern. All right. So that's the trigger to go short.